Welcome back, investor. We've got another episode of Passive Income Adventures. If you're new, my name is Emma Powell. My husband and I have spent the last 7, almost 8 years building our own personal wealth portfolio so that we could retire early. About 3-ish years. I think we just hit a little over 3 years ago, we hit our anniversary for retiring early. He was 49 or 48. I was 46. And we were able to kind of let go of the corporate, let go of the W-2 and pursue some personal interests and business interests without having to worry about how we were going to pay for our lifestyle. That it doesn't mean that there were some tough times and uneven cash flows and all the things that we deal with when we are living on self-employed or irregular type of passive income. And so this show is really to teach you how to first achieve that point where you can decide how and when you want to work, and also so that you can figure out what it really looks like. The psychological impacts of it, the financial impacts of it, just navigating it. I just haven't found a lot of content out there for people with this problem because it's usually considered like a high level privileged type of problem. But problem it is nonetheless, even if it's a high level one. And so today we have a developer on with us, Andy Ahitow, where he is in Chicago, and he is developing some pretty interesting projects in Los Angeles. And we're going to talk about like the type of funding these projects are needing, the changing funding landscape, where you might fit into what types of projects you can fund, educating yourself better on the actual assets that you're going to be looking at so that you can decide, does this operator know what they're doing? Is this project viable? Is it in the right place? All of those types of things. Specifically today, we're going to be talking about multifamily real estate, but you can kind of extrapolate these lessons to the broader world of whatever it is that you're looking at investing in, so you can just be a more educated consumer. And if you are perhaps an active investor, and especially if development kind of rings your bell a little, when we did our first couple developments, I felt very unsupported. I couldn't find people who were doing it. I couldn't find resources online. And so I try to bring different types of operators and developers on here. So if that is something that you're trying to pursue actively, hopefully we can give you some good information that you can go and do further research on. But if you're just a passive investor, we all start at the same place. And so one is just going to get more detailed than the other. But as we start in that place, we're going to have Andy kind of guide us through what it looks like to do a development and how to passively invest in that development. So thanks for coming on the show, Andy.
Yeah, happy to be here. Excited for the conversation and tell you guys about myself and our projects. Anything you want to know?
Yeah, I know I mispronounced your last name. I apologize. How do
Oh,
you name?
I think I maybe have had one or two people in my life ever pronounce it correctly before me telling them how to say it, and I have friends that pronounce it wrong. So
Yeah,
it's fine. So the last name is pronounced Ato.
that is
It's a Sephardic Jewish name from Turkey that my grandfather supposedly Americanized when he came here. Not quite.
okay. Okay, not close enough. Yeah. Yeah, because sometimes I'll see a name that has some sort of a roots in another culture, and so I'll pronounce it like the way that it's and they're like, yeah, that's not how we say it in the United States. And I'm like, I know how to pronounce anybody's last name. And I'm like, I know I'm butchering this. So thank you for coming on the show, Andy Ahitow, which is good because I feel like when I first saw it, I was like, I'm just guessing here. So
But this
yeah,
is
well,
typical pronunciation for someone who doesn't know. So I'll
yeah,
get it.
it's like a choose your own adventure. That's what we do on the show. Choose your own adventure. We'll help you figure out how to pay for it. So you get an adventure with last name. I had kind of a strange maiden name, so it was kind of nice when I got married. I could ditch that and have something that everybody could easily pronounce. But now it's like lots of people have this name. So, pros and cons, right?
That's right. Your name is common. There's lots of Powells out there. So if anybody pronounces that wrong, they are probably not English speaking.
Yeah, exactly. When I was growing up, I was the only Emma. There were no other Emmas. And so I got used to hearing, if I heard it, they were talking to me. And now I hear it in public, I just ignore it. People are like talking to me, and I'm just like, not even paying attention because Emma comes in like waves. And so when I was growing up, it was a unique name, but now it is not. So, yeah, you do what you can. I think that kind of recognition and people knowing you and pronouncing your name, I think it's a huge part of capital raising and getting that
Sure.
reputation and that ability to be relatable and all of that. So I feel like these podcasts and things give us a chance to talk to people where they can get to know us. So in that light, can you tell us a little bit about your background in the world of real estate development and maybe private finance? Where did you start? what were some of your pivot points? And then how did you end up with the project that you're doing right now?
Yeah, sure. So it's been a fairly long journey. 26, 27, about 26 years ago, I started I wanted to get into real estate. I was fairly young at the time and decided that real estate would be a career for me. And I wanted to learn the real estate side of the business through apartment leasing and the multifamily space. So I went to work for a company called the Apartment People here in Chicago
Yeah.
that leased apartments for third party owners. Did that for about a year, and I'm entrepreneurial as you can imagine. So I decided to leave that company, who was doing a lot of business renting apartments. I think they claimed they rented like 18,000 apartments that year. It was a crazy number. I think they exaggerated the number, but it still was. I believe they were renting a lot. I think I almost rented 300 apartments that year. So left the Apartment People, started a company called the Chicago Apartment Finders, and the idea was to, start leasing apartments on our own. It was a college buddy of mine, Justin, that went to the University of Iowa with me, and eventually, a year or two later, we'd start buying some buildings in Chicago and build a portfolio. Well, we didn't realize how successful we would be at leasing apartments. So we didn't buy anything for 10 years. So,
Okay.
rented 3,000 apartments in our second year of business, and then eventually got to an average of about 5,000 apartments per year as a brokerage. So built up this very successful real estate brokerage, generating almost $10 million a year in gross revenues.
Wow.
That was an incredible experience for me. I tell people that I got my MBA without going to school, because I learned how to operate and run a business and manage over 200 people, and had to do that learning on the job. But I had a business coach to help me, advise me along the way, giving us, basically instructions of how to build out a policy and procedure document that helped us run the business. Cause you never know when someone's going to leave and you have to replace them, and you want to replace them without having to train, spend hours or days or weeks training them, getting them up to speed. So we created this unbelievable set of documents and books that helped us run the business. Built out software that was proprietary to the business. It was a really cool success. That story has a lot to do with what I'm doing today. Um,
Yeah.
it really taught me everything about rents and what people look for, the types of apartments that they want and truly can afford.
Mhm.
It was, it became, real estate and architecture, all those things always been a passion of mine since I was a little kid. So getting into development was a natural transition for me. When you fast forward to now 2009,
Yeah.
and there was an opportunity to buy broken and fractured condo buildings all over Chicago. There were hundreds of them that banks were
Yeah.
selling. I partnered up at that time, leveraged our business, partnered up with some guys with a lot of money, got lucky, found this family office that owned a couple million square feet of commercial office space in Chicago. They never really owned or operated any multifamily. So they said they would fund a deal if we found it. We found one. A month later, we found a portfolio of 7 buildings. They said, all right, we'll do that. We want a 5-year exclusive on you. We ended up buying 1,400 apartments with them over the next 4 years. And then Coldwell Banker knocked on our door to buy Chicago Apartment Finders in 2014. And that led to an opportunity to negotiate a buyout of that portfolio with those guys, because I had
Yeah.
what's called a promote interest in those deals. So I
Yeah.
negotiated a buyout of that promote interest, sold the Chicago Apartment Finder business, and then 2015 started CityPads, which is my current development company. And I now had enough personal capital and experience to go off and be a developer. I mean, it's not easy to go off and go into the development world and just be on your own doing development, because it's, as you said, it's your income is lumpy, not
Yep.
always consistent. You don't know when the next check's going to come sometimes. So you need some cash, and the banks won't lend to you without a balance sheet. Investors don't want to invest with you until you have experience.
Yep.
So it was an amazing opportunity for me to kind of pursue my dream of being a developer and having that be my only focus. And we started small. We raised a couple $1 million from friends and family, invested alongside them, did 5 projects, and then grew over time to today, where we're exclusively building ground up developments that are these infill projects, that what I believe to be the perfect type of apartment building that renters, mainly young, for the most part, younger renters, you know, early out of college, first 10 years out of college, are looking to rent. And that obviously is something I know really well, being, a person who had experienced or looked at over 60,000 applications over the course of 13 years. We knew not only we fill 60,000 apartments, we can only imagine how many people that didn't rent from us. I mean, we had hundreds of thousands of people coming through our doors. So we really have an incredible understanding of what renters want. And for the most part, today's developments don't really cater to what most
Mm,
renters want. They want to, live near work. They want to have the amenities that they're looking for, which is not all of the amenities being put in these buildings, but
oh,
the co-working lounge, some outdoor space, and most importantly, the neighborhood they want to live in. They want to live in a neighborhood that they like or that they've heard is cool for a price point that they can afford. And sometimes you have to build a little bit of a smaller apartment to make that more affordable, but
mhm.
people are willing to sacrifice that space if you can build an apartment in the neighborhood they want to live in. So that's what CityPads is doing. To fast forward to today, is we're building these in neighborhood infill sites. Started in Chicago, obviously. Now we're expanding out to LA, and that LA expansion has a story there that I'm happy to tell more about if you
Mhm.
want.
Yeah.
It's just all by having boots on the ground. For me, I would not trust expanding to a new city without having a partner I trust out there, and we have that.
Yeah, that's a good point. I mean, okay, so many things. I'll just ask you some kind of rapid fire questions, and then we can pivot a little and dive more into what you're working on right now. So, the property management apartment people, say the name of that business again.
Yes, the
It was a
apartment people was the first business I worked for, and then I started Chicago Apartment Finders. The second, it was a company that I
got it.
founded in 2002.
And then, was that a full scale property management company, or were you just doing lease up specialty?
So we were doing third part. So Chicago's unique that third party owners would pay a 1 month commission
Mhm.
to a broker if you found them a
Yes.
tenant, and we
Oh,
were not. It was all non exclusive.
got
So
it.
other brokers were working with the same owner. So we basically took a lot of the people that the apartment people, all these companies that the apartment people were working with, and just went and knocked on the door and said, "Hey, can we work with you too?" And they said yes.
Okay.
So we did third party leasing for the first 6 years,
Hmm.
and then started doing individual condo management to start a management company.
Okay.
And then as we built that portfolio for those guys that were investing with us to buy fracture brokered condo buildings, we built out the management division, which grew quite large. And we had almost 1,400 units under management.
Okay. Yeah. Okay. Interesting. Specialty there. I know that I always make a joke. When the joke with contractors, you can either have good quality, good speed, or a good price, but you can only pick two of those things. This is why I've always said with property managers, they're either going to be good at leasing, construction, or accounting, paperwork, but you can only pick two of them. And so I have always said that you kind of have to bring in house the specialty that they're lacking, because especially if you're in multiple areas of the country and you have multiple third party, before you're big enough to bring all of your entire property management in house, you kind of have to deal with third parties. And so for some teams, we have to do a lot of the lease up side, and for other teams, we have to do a lot of our own accounting, or we have to be close enough to the building that we can manage the construction ourselves. It's kind of fascinating to see how nobody can really get all three of those right. And so I love that you're kind of taking the leasing aspect from the specialization and saying like, look, you just be really good at construction, um, building maintenance and paperwork, and we'll take over the leasing side. I I I mean, I'm aware that commercial real estate agents do that for commercial spaces, but I don't think I've seen that in multifamily. Is it just like a Midwest East Coast thing?
We used to be part of an association that was basically mom and pops all over the country. So there are leasing brokerages in Texas, Florida.
Mhm.
There was a big company in Boston, DC. The West Coast, I don't think we had any in that association. I don't think anybody in the West Coast was involved. So maybe it's not a common theme in the West Coast. I do know a Chicago company has expanded to Denver recently to help
Okay.
a lot of the Denver developers, manage their lease ups.
Okay.
So maybe it's becoming more common. I will tell you, I today avoid paying brokers because I know how to do it
You
myself.
don't
And
you don't know how to do it. Yeah, you probably, like, understand that all 3 of those things are important for a successful company, but it's just, like, sometimes people just struggle with one or more aspect. You also said something kinda interesting about how you had a business coach to help you with your standard operating procedures, creating, really beautiful, like, master plans that are very easy for people to use when they transition out. My sister-in-law actually does this as a career. She has a curriculum design, a degree, master's of curriculum design, and she'll go into a company, larger organization, and she basically just designs all of this stuff. She follows people around, gets their procedures, writes it all, training videos, manuals, the whole nine yards. And my dad used to do something similar with systems analysis, where he would create software to automate, the paper and pencil tasks, and he would follow people around, watch what they did, almost like an ergonomic study. But then he would develop a piece of software that would make this more efficient. So I think that a lot of times people, don't give credit to people who have already done it, and hiring consultants and business coaches and things like that to help you run your business well. Because if you're a visionary and entrepreneur, sometimes the admin and procedure is something that you have to be taught. Because I know myself, my organization is what I call mechanical. That ADHD, I had to learn how to do, and it was not like I wasn't born organized, my lady says. So that's so important. Can you talk to the importance of for the investor of vetting somebody out, an operator who has operations experience and operational systems in place that make a business repeatable? Because that's what large capital is looking for. How cookie cutter is this? How similar is this to what you've executed successfully before? And I don't think that retail investors tend to look at the operations side with an eye towards how organized is this group of people. So just educate us on the importance of that and how people can do due diligence on that. What kinds of questions should they ask, or what should they do?
sure. Yeah, there's a lot to unpack there because there's so much that I have learned in my career that I think added an incredible amount of value to what we do and to our investors. And, um, we work with a lot of sophisticated folks that ask a lot of smart questions, and they invest a lot of money with us, but a lot of it has to do with, my experience and background. And that builds a lot of trust in people, even though they may have just met me. I mean, I have met people in airports that have turned around and invested hundreds of thousands of dollars weeks later because they might know somebody who knows me, right? They do their background checking, but they hear my story and they validate that that's legit, and then they become comfortable. But um, things that are really important. I mean, organizational skills are not typical in an entrepreneur. It's normally entrepreneurial people tend to be really good at coming up with cool ideas and
Yeah.
hustling and working really hard and going out there and getting things off the ground and making it happen
Mhm.
and getting the business going. And then when the business grows and it scales, they're scatterbrained, and they sometimes things don't start going haywire. Even though it's an incredible idea, they may have the best idea in the world, but if they don't figure out how to organize their business for growth, they're eventually things are gonna break, and that amazing idea becomes a horrible investment because they're disorganized, or their business is disorganized, or they start making bad decisions because
Mhm.
they're not looking at data to help back up those decisions. So I mean, things you want to ask are what are people's what are their backgrounds, what is their experience that leads to them to be able to be successful in development? Do they know, do they have a background in construction? Do they have a background in property management, leasing? What is it about their background that gives them the expertise to execute successfully on a development? That's a good place to start. Hopefully there's a story there as to what led them to be a developer. And if they get past that, the next level is, looking at the financials of a development. And then understanding how that underwriting was created. You know, where did they obtain the rents that they're assuming, their hard costs, and their construction costs, and are those substantiated by other apartments that are in the market, or other, other contractors that have given you real pricing, reliable pricing? And if and are these contractors trustworthy themselves? I mean, there's so many areas you can go wrong in our business, and it's so important that you know what you're doing to figure out how to avoid all those pitfalls that you could end up dealing with. Um, it's hard to know as an investor. How do you get to the bottom of whether somebody has done their job to check all the boxes to make sure that their money is safe? And I don't, I don't know if I have a magic wand that I can wave and say, these are the 5 questions you need to ask, but it's, definitely want to check someone's background, make sure there's a story as to why they're in the business. Number one, I think that's critical, that they're not just developing because they're wealthy and they want to do it themselves and they're asking you to put their money alongside them.
Yeah.
And then, what is their due diligence process? What do they do to verify all of their numbers that they're putting in their underwriting? And one thing that I don't think a lot of people realize is when somebody tells you what the return on costs are, what the estimated returns are, most of the time those numbers are trended, right? So the developer is saying, yeah, here's today's rents, but I'm basing my returns on rents 5 years from now. And
Yeah.
that's a big, like smart institutional investors, they pick up on that really quickly. They
Yeah.
typically do their own underwriting based on today's rents. And sometimes they'll even look at trending the construction costs. So they'll assume escalation in construction costs,
Hmm.
which is conservative to do. And then they'll take today's rents. So they're really,
That's very, yeah.
testing those numbers in a conservative way. And we always look at it both ways. Of course, we trend our numbers because rents in Chicago have done really well. There's not a lot of new supply here, but we always look at the current return on cost based on today's numbers. And, as long as we can build and make the math work on today's numbers, the trended number is only going to make things better. And if you don't know what you're looking for, it can be hard to figure out what, how to read the underwriting models and understand what the comps are. Um, you know, comp, Comping an apartment building is not always that straightforward either. Not as simple as going on apartments.com and saying, okay, what are other buildings in this neighborhood renting for? There's a lot of hidden information on rents. There's hidden fees that renters don't always know about. That's not always published online. There's concessions being offered by owners that people don't always publish online. The actual rent that people pay is not always the same rent you see on the websites of these buildings. Number one. Number two, and I'm always selling against this because our projects we use small units to drive affordability and small units to drive up the rent per square foot. So it's a win-win. We have a high return on cost because our rent per square foot's high, but a lower chunk rent because we're trying to keep the units small, so it helps sell our units. So that's somewhat unique. There are not a lot of developers that take that approach. So I'm always trying to find the exact buildings that I can compare my units to comp those buildings. And then what I'm always up against is other people going online. Even the smart investors will go on apartments.com and they'll say, well, how are you going to hit that rent per square foot when the 5 buildings around you are much lower?
Hmm.
And then I have to tell the story about why our units are smaller and how we design them very efficiently. And, it's all about the chunk rent. Renters don't care about rent per square foot as
Hmm.
much as investors care about it. And they think it's the most critical thing to look at as a comparable. No, not for the most part. Renters will never ask, how much does that apartment rent per square foot? That's not
No,
a question that comes out of a renter's mind. So a
I
lot of things to check, a lot of things to look into. I guess I could keep going, Emma, but I'm sure you want me to answer other questions.
Oh no, it's fascinating because your insight into consumer behavior is really a huge part of what you're describing as your success stories, knowing what renters want and the kinds of questions that renters ask. And I mean, I didn't hear price per square foot until I got into commercial real estate as an operator myself. And And then it was different, like price per square foot on the residential rentals versus price per square foot charge per month on commercial. I like all of that was completely new to me. I would not have been asking those questions um, as a renter. So given that uh, consumer flavor, consumer demand, um, tell me a little bit about the apartments that you're developing, because what you're discussing here is a lot of like, I'm hearing like, I'm seeing sensitivity tables in my head, like, trended construction
Mhm.
prices versus in place rents. You're going to trend your rents, and these things are going to kind of slide together into some sort of a matrix, supply and demand curve type of intersections. But it's the same thing that you're saying on price per square foot, that you say, okay, our apartments are overall cheaper because they're smaller. And so that price per square foot is going to be lower over here. But then you've also got, like, when we do our rent comps, we've always got a table like, what was the year built? How many units are in the building? Because a 300 unit building is not going to be renting for the same as a 12 unit building. All of these types of things that you're going to have that are interacting for these comps, and they're not going to line up. You're not going to, like you said, you're not going to find a good comp. It's not like a tract home in a neighborhood where the same floor plan across the street. All of these properties are very unique. And so understanding that consumer behavior is super important, so you can kind of build out these matrices and figure out what they want. But the thing that I think caught me when you're talking about Chicago versus LA, and you're talking about city people who want walkable neighborhoods, smaller units, things like that. This is something we bumped up against too in our first large development, because we were building in a transit area of downtown Salt Lake City that was near a light rail station, a heavy rail station. It had a bus stop right in front and was right off of our major nature trail. It's a paved 40-mile trail that runs basically from north of Salt Lake to south of Salt Lake. And it was all right there. And I would put that right in our pitch deck, and why we wanted to have only half a parking space per unit. And investors were just rejecting that completely, because they're like, well, we tried that in a university town and it didn't work. And we just heard it again and again, after, from high net worth people to institutional investments, even opportunity zones, which are funds, which are for distressed kind of urban areas. They still weren't seeing the vision of this transit area. And we had no, no entitlement friction. It was a right to build. So as long as we built according to code, they kind of had to approve it. There was no city meeting. It was super low risk from that end. And we got it all done and designed. And it was a lot of work to get it to the point. And investors just kept turning it down and turning it down. We ended up having to put in underground parking because they just could not get behind a building that didn't have 1.1 parking spaces per. And so the consumer behavior is what they kept citing. They're like, it's a transit area. I don't care what the city says they want. I know what they want because I've been doing apartments. And like, but not here, this location, this particular corridor in this area. And you know what? We got 1.1 per person and we got some investors, but it was incredibly challenging because of that consumer behavior that's talking. So can you dive into that a little bit more, understanding your market, understanding your product, so that you can relate to your potential investors?
Yeah, it's really important, obviously, to be able to tell that story as to why you're doing what you're doing and make sure you can back it up with data. And sometimes that data is hard because TOD policies are new.
Yeah.
Transit policies, the municipalities all believe in them. They think that's the future of their city. And if we build thousands of apartments, we're going to create these incredible walkable neighborhoods. Maybe. There
Yes.
are, their urban planning is not an automatic, right? You need to do it the
Yeah.
right way. And the way I look at it is, if you can, hit the three things that are critical, that you can, well, I was going to say live, work, play are the three things you want to hit, right? But live is what we're doing. So if you have work and play accessible to where you're building,
Okay.
walkable, transit-oriented policies are going to work. Absolutely. And you can read all kinds of books on real estate, location, and this whole idea of the 15-minute city. It's all about, if somebody can walk to work, they can walk to a great restaurant, they can walk to a bar where they can have a drink, they can walk to a coffee shop, they can walk to grocery, they will live in that area, of course, because it's everything they need is right there. There's no
Yeah.
question that somebody would want the access to all that. Who wants to be in the car driving forever to work or forever to a restaurant? People don't want that, but they do it because out of a necessity, because the housing is being built a mile away from all that,
Yeah.
and they need a car to get to those things. Um, so you just got, yeah, you need data to back it up. We do, we get parking studies to back it up. Even though I have the experience, and I could tell the story, and I could tell everybody why I believe in it. We own apartments in Chicago that have no parking, and it works fine. We'll do that in LA. Well, they're like, well, show me a building in LA that has no parking. And they're not that, there are a lot being built. And I'm not sure if everybody knows that, but there's a lot of apartments being built in LA without parking, but not a lot of opened. And there are more and more opening every day. So we have to sell that story based on, the idea that people, to sell the story on live, work, play. We're 10 minutes from all these jobs. We're 10 minutes from the train. We're 10 minutes to grocery, and all these things are accessible. And then when you show somebody the site and then you walk it with them, get out there and physically walk the site with them, they believe in it. They'll believe in that story.
Okay.
Tough sell.
It can be. Like I said, we ended up adding underground parking. It was a podium design, so above ground,
which is expensive. That's a lot of cost.
Well, the podium was expensive, but the underground was because we had the water table was too high. We had the pump system. I mean, it was a heavily engineered, but we could not.
It's millions of dollars to take away all that soil and
there goes their return on cost. And so it really was stressing what was a great deal at half a parking space per person became an okay deal with underground parking. So, but you got to get the deal done. The other thing we bumped up against is like, have you ever gone vertical? I'm like, no, we're not going vertical with this one either. Like, we're just getting it shovel ready. Right. And so that was a huge problem for a lot of investments. But another thing that I bumped up against a lot with my architect, who was fantastic. I mean, I recommend him to everybody, but bumped up a lot with him. And then some of our potential investors, our larger institutional investors, were the amenities. Like, nobody does swim in that pool. Okay. Nobody is going to use that, this or that. I was like, they want co-working spaces. They want podcasting studios, booths where they can take calls. They want exercise, and they want a place to take their dog. And so I was listening out. So we had different amenity on each floor in this little public space where the pool was supposed to go and all this. And I'm like, we can't afford that. And it ended up getting a pool eventually as the scope expanded. But I was very adamant on the types of amenities that young professionals who live in a downtown area would actually use, because we were going through apartments and it's just empty. And they're paying all these common area maintenance fees for empty amenities. And so I just spent a lot of time looking at like, what are they actually using? What are they actually wanting? But it was like, no, this is how the standard product is. And they didn't want to be me blue oceaning anything on their dime. So
we are so much in the follow the herd mentality business. I mean, all the developers want to do what everybody else is doing. The institutional capital,
it has to be
really bad at that. They only will put their money if you're doing what everybody else is doing. You cannot be outside the box. And doesn't mean they're right.
Invest something that's outside of someone's box. Like, if you haven't done this before, I'm putting my money in it. So I get it now I'm kind of out of the game. I'm just passive, kind of retired. And I feel like now I finally get it when somebody calls me up and they're pitching me a project, and I'm literally rolling my eyes like, they have never done this before. But that was me like 8 years ago.
Exactly. Right.
Yeah.
You have some compassion for them at least.
Yeah. I mean, because that's true. Everybody started out not having any experience, but these types of things are the questions we should be asking you as a developer. Like, what have you done? Have you done this exact thing before? But I always want to see, especially an incumbent with experience, like pushing those boundaries a little bit with each project. Like, fine, we'll put in the pool, but we're also going to have co-working spaces because that's important to our people. Maybe to make the pool smaller and get a conference rooms, things like that. Okay, something really dumb that I got a lot of pushback on is that I don't want gendered bathrooms in the public areas. And they were like, what? And I said, I don't want to get into any of that mess. I don't want to go down that road. All the bathrooms are going to be self-contained with the toilet, the shower, and the sink in the same little with the door, because I don't want to get into any kind of gendered bathroom issue, because people can use whatever bathroom they want. And they were like, just lots of arguments against it. And I was like, no, this is what I want. That's what you're going to. He had 2 bathrooms, a men's and women's bathroom. I said, just make 2 unisex.
You mean in the amenity spaces?
In the amenity space, like the leasing office, the public areas. I wanted all just like, instead of a men and women, I just wanted 2 self-contained. And I couldn't believe the pushback that we were getting from even investors. Like, what's this? Like, do you guys not have newspapers or listen to the news? Like, this is a big deal. And I didn't think that was pushing pushing too much,
Yeah.
but that's an example of how entrenched this kind of stuff is that I couldn't even just say, we already have 2 bathrooms, just put a urinal.
Sometimes the questions that people get hung up on or the issues is strange.
It was crazy. So, all right. So as we're kind of wrapping up here, there are 2 more things I want to ask you more a little bit about your personal journey. But before we do that, I want to get into a little bit on what we're talking about with types of investors. Like we're throwing words around like private investor, institutional, so, and I said retail investor. Can you just give us your kind of sliding tier scale of, let's say we've got public equity, stock markets, and and it's private equity includes everything else other than loans, private debt. So private equity is a huge definition. It's getting a lot of a bad press right now because of Joann's and Red Lobster and all that. So can you describe to us what private equity actually is in the broad sense, and then kind of define the tiers of people that you're dealing with all along your capital stack, because you're dealing from very large institutions to retail investors and everything in between. What does that look like? And so that people can kind of identify what tier um, they are falling into and how much clout it has if you're getting a retail investor, if you already have some institutional venture, um, not that you're a venture, but venture type of capital in your thing.
Right.
Just explain the whole thing in a nutshell.
Yeah, I think to simplify it, retail capital are individual investors,
Mhm.
whether it be a high net worth individual or somebody who makes enough money to be accredited and they want to, and they're your buddy, they want to invest, 50 to 100 grand. That's a retail investor. Institutional investors is a bucket that are typically large scale funds. And that the money they raise will come from true institutions, pension funds,
Okay.
sometimes public REITs will invest with they'll place capital with a large scale fund. And those are the quote unquote institutional groups that we would go to provide the large LP equity, the limited partner equity, which
Mhm.
is in traditional sense, 80 to 90% of the equity stack of a development.
Okay.
Um, and then the rest would, you would either invest it yourself, personal capital, or you would go with friends and family capital, all retail. And that's typically done through some sort of syndication, right? You're syndicating the equity, meaning you're pooling together that capital in an LLC. Those investors all have their pro rata interest in that LLC. And then, that's the idea of retail capital. Today we're raising, uh, all of our capital through retail. Some of it's high net worth. So I'm sorry, some of it's family office. So they're investing, millions of dollars at a time. So
Mhm.
you might want to think of that as institutional, but
Kind
it
of
really isn't, because
it's in the
those
middle.
family offices yeah, I would say that's more in the middle, right? Where they may be $1 billion family office,
Mhm.
and they're capable of writing very large checks, but they operate very much like a retail investor. Right? They're asking similar questions.
Mhm.
They're really only investing with select people that they've gotten to know over time.
Yeah.
You're not meeting a family office tomorrow and getting a check from them a month later. Those relationships are built, over typically a year to 2, 3 year time. Um,
Mhm. Different legal, I don't want to say legal structures, so different legal types of regulations and protections that they enjoy from being there. They're kind of in between that retail and that institutional space. They are a business, but because it is family members are all sitting on the board, it's a little bit different. I don't think um, that doesn't affect us too much from a project base, but I find that some of our wealthier retail investors really should be looking into creating a small family office, and there are technical tools now that enable that, and it's not something they thought of because traditionally family office has full-time accountant, full-time lawyers, full-time advisors, and so now they can kind of get into those fractional advisors and some tech stuff where family offices, I think, are starting at much lower net worths than they have traditionally, which is maybe $100 million family net worth, now down to 10 million. I've seen even family offices where multiple family members have a collective 10 million net worth and they're starting these family offices,
right.
fractional and technology, tech tools. So that's something that I think that some of our listeners might be like, oh, that's something I ever thought of, that I might need some estate planning and some legal formation that we can maybe operate a little bit more along that family office model that a lot of people wouldn't really consider themselves a part of.
Yeah, there are these new family office groups that have kind of pulled together multiple families to
Right.
create that infrastructure, so that because it's expensive to have all the team of people managing
Mhm.
your money for you. Another thing that's happening out there that's changing the landscape of deals or of access for us to capital is this whole RIA world,
Oh,
and
yeah.
that's hard to get into. So like it's hard for us to get into that, to have access to that capital because they're fiduciaries for their people they manage money for. So they want to see, typically large scale developers can only access that resource because they need, for securities laws, they want to make sure you've got a significant track record. And not only have you built a number of projects, but you've also sold those projects and you
Yeah.
demonstrate the returns that you're selling in your new package is something that you've done multiple times
Exactly.
before. But the
Yes.
RAA world is growing, and that's another way for investors to tap into developments. If their wealth management firm um, is 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 finding access to real estate syndications,
Okay.
they've done some homework and kind of vouched for those projects. It's not. It's. I don't think it's easy to find a wealth manager that has access to, that has an RIA shop set up, but it
Mhm.
is a growing space, and I know a lot of wealth managers are trying to create alternative investment access for their
Yes.
clients, and I'm trying to get access to those wealth managers because
Okay.
we're trying to grow our platform and have access to more investors. And that's, it's a lot of work to focus on growing our investor base. At the same time, I need to keep my eye on the ball and build great buildings and make sure those are successful. So, it's
Yes.
kind of balancing those two can be challenging.
Yeah, I've not been able to break into the RIA space, which a registered investment advisor for anybody who's listening, like, what are we talking about? So wealth management services with registered investment advisors, they have a fiduciary duty and because they're licensed, so that they have to make sure what they're recommending that they can support if it ever comes back that this didn't do well and their client's upset because they recommended it. They really have to be able to show that they've got their third party due diligence reports and that they've got experience. And so there's a heavier weight on them to recommend something than there would be so I find them to be very schmoozy. Like you guys spend some money, you got to go meet them in person, you got to sit and have lunch, and those relationships with RAs are just as intensive and probably more expensive with the schmoozy part than with the retail investors or even the family offices. So I've really not been able to break into that space because I'm not that I just my personality. So but it is a great resource for the listener who might have access to an advisor at maybe even a firm they're already using, or to go find somebody because if you're looking for access to good deals and vetted deals, that they have connections because that's their job is to vet this kind of stuff in the alternative space. So, and I'm also seeing big strides in technology here as well with when the stock market first got fractionalized shares and we didn't have to buy a whole share of stock and cheap trading platforms and all that. I'm kind of seeing these technologies innovate in the
So
private
the idea of tokenization, have you dabbled with that at all?
tokenization, and there are some huge problems to creating like a private market index. I've talked about it on the show plenty of times. It's something I'm a little bit like obsessed with. But there are some huge things that are never going to make it like a public market. But at the same time, we can approach that with a lot of these technologies for fractionalization, and then evaluations. There are just all sorts of things that are kind of missing right now to enable that. But I see us getting closer and closer in data science and AI tech world to building tools that can do these things. So I'm really excited about it because I feel like it will open up this to many, many more people and make it easier to underwrite even for large organizations. So I I don't want to derail us too much there, but it's something I've been thinking about a lot over the past year and a half. So I always have to put that in there. Keep your eye out for um, democratize technology for access to these alternative assets where you don't have to go through gatekeepers and the underwriting is not as like overwhelming because you're gonna help is on the way is all I'm trying to say there. But um, apologies for my little aside. But let's kind of have you wrap up just telling us your kind of personal journey through this. Where do you see your company going in the next 5 years? I know the funding landscape has changed dramatically since 2020 institutions really changing what they're gonna what they're going to fund. Even retail investors at Gen X's, there just aren't as many of us. The boomers are retiring into boring investments, even more boring, like, because they already have built and they're more into wealth preservation and super, super safe, very boring stuff. Low yield is what I'm trying to say by boring. And so I feel like you've seen a lot of changes over the last couple of years. We're going to continue to see more changes over the next 5 years. Where do you see your business going? And then you and your own personal finance journey, your own passive income journey. Tell us about what that looks like over the next 5 to 10 years.
Yeah, sure. I'll tell you all about both. I mean, we're 10 years old as a business. We have incredible growth plans. We're launching another GP fund this year. We're going to raise, our goal is to raise $25 million that will place into 8 to 10 projects. That'll be a 9-10 year fund. Probably do another one after that. I consider myself to be relatively young, even though I'm not that young anymore, but still young enough to, what's that?
You're a lifer. You're in it.
I know.
Your fund, you have to still manage the asset even after the fund closes and stuff. You're
so
in it
true.
now for 20 years, I'd say.
Yeah, I don't know. I don't really see myself ever stopping working
Yeah.
completely. It's one of the beauties of development and owning real estate is that you can slow down, keep working, and just do a little bit less, and still have something to do. But that, for the time being, I'm still, working for all the people that I raise money from. Those are all my bosses, and I'm going to keep doing that for a significant amount of time until I have, I don't know if I have a specific number in mind, how much money I want to make before I kind of stop doing that. But at some point I'll decide that, okay, now it's time to slow it down a little bit and eventually just place my own capital in my own projects with only maybe my partners or a couple other people that are, a little bit less, a little bit easier to manage, where I'm not having to spend as much time reporting and just
It's very labor
kind of
intensive.
enjoy. It's a lot of work to provide that quarterly reporting and to answer the questions that come in all the time. And I'm happy to do it, but it does add a lot to your plate. And at some point you won't want to do that. At some point I will want to slow down and be that passive investor and maybe invest in some other people that I know and trust. But there's no question at that, I won't just park all my money in the stock market. That's something that I'll never do. I do have money in the stock market because I have to have liquid assets to get loans, but I also don't see myself ever being, that kind of investor that says, all right, I'm just going to live off of my dividends on my stock portfolio. That's
what I mean by boring.
not in my DNA at all. That's for sure.
Yeah.
So, long term, we'll, take the money that we've worked really hard to create and buy some assets in Chicago, LA, or maybe other cities, wherever I decide to move, and manage those assets. That'll kind of be my retirement play at some point.
Yeah. I mean, the minute you stop working is the minute you get old. I mean, we've seen this before, people who retire and they're age very rapidly. We see the same thing, like, though, with the president who comes in and 8 years later, like, wow, haggard, right? So there's a happy balance between those two aging protocols. Slowing down ages you, taking on too much ages you. But I feel like having passive income allows you to kind of choose how far on each side of those lanes you want to be, because it's important to stay engaged and active. And you're creating something affordable, nice, safe housing that this country is in desperate need of right now. And so it's got to feel like mission driven to be part of delivering that product. That's a win-win-win for the society, for the people living in them, and for you as business people funding and building them. So that's kind of where the beautiful intersection of those things come in.
Yeah. When I'm telling people about what we do, I feel passionate about it. I'm excited about it. I'm very proud of what we're doing. And when we build these buildings and they lease up overnight, it's no surprise to me, because it's so obvious to me that not enough developers are creating housing at a price point that people can afford in the neighborhoods they want to live. I mean, it's, I try to simplify our story because nobody wants to listen to a long-winded speech, but it's really as simple as building housing people can afford at the price point they want in a neighborhood they want to live in.
Yep.
That's
Exactly.
simple.
Yeah. I felt very proud of what we created because Salt Lake City in Utah specifically is very, very short on housing, thousands of units short. And I definitely took comfort in the fact that we were helping deliver that. So I think it's just needed. It's super risky. I mean, what is it like? Development's the only profession where you work for 2 or 3 years and hope you get paid at the end. Or somebody else said, another developer said one time, he goes, development's one of those things where you either make $5 million or you lose $5 million. It's like the answer, it does not
Holy,
work.
it's funny, but that's not funny. It's absolutely true. I know people
It's
that have lost all their money they put into the deal because they did not know what they were doing, or they just got unlucky with timing.
yeah,
Um,
it happens to the best of them. I mean, I've heard some stories recently. Yeah, I think when the best time to invest with somebody is just after they've been out in a downturn, kind of like what we're going through right now, the correction,
Mhm.
and they come out of the other side energized and ready to take advantage of the next upcycle. So you're positioned very well because you're already in this particular space 10 years, and then you now have these weather marks on your business or the difficulties we've been having over the last couple of years in commercial real estate. And when you come out the other side, you're going to be the guy people are like, "You've been through a downturn, like take my money." Right. So
Love it.
yeah, you're well positioned to do that. So how do people get a hold of you, Andy, if they want to either invest with you or just get some introductions to people that you might know?
Anybody can email me, Andy at citypadsre.com. And that's also our website. Or once you email me, my cell phone number is on my email. People call me all the time. So, but the email is the best way to send an outreach. Hit me up and I'll respond quickly. I'm kind of those people I'm not on email all the time, but I somehow have an inbox zero policy that works really well.
Oh, goodness. Yeah, I did inbox zero for like 5 minutes once. Do not email me. Go to investwithemma.com. That's my calendar. And I wake up, I live and die by the calendar. So I wake up every morning, I go to bed every night, check everything, set all my alarms so that that's the best way to get a hold of me. And then once we have that initial conversation about whatever you want to talk about, like, real estate or investing related, I love just connecting people and seeing if seeing if I have somebody in my network that does what you do. And I'm not recommending anybody. I'm not a financial advisor or anything like that, but I can definitely make introductions as step one for your own due diligence. Remember that. So investwithemma.com, or that you can go to Andy at citypadsre.com if you want to get a hold of either one of us. And thank you so much for spending time with us. I feel like this is what we do on the show, is figuring out how to help you build wealth so that you can build the life of your dreams. Have an adventure, and we're here to help you figure out how to pay for it, no matter what that adventure looks like. So appreciate it, Andy. Thank you.
Thank you, Emma. It was fun.
All the listeners, and I'll see you next week for our next passive income adventure.